Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
All right, a little notebook review here today. Apologies for making it not apologies, but a little changing it up where we're doing kind of 12:30 midday session here versus after the close. Kind of a little bit of a benign day out there, to be perfectly honest with you. Volatility, SPYs or SPX is, I'll call it flat, down about 15 basis points. Nasdaq's down about 56. Russell's up about 50 basis points, which is interesting. A little bit of a dichotomy there between the three major indices. I think the interesting thing out of that call out though is certainly the volatility measures, right? So VIX's actually up to about 18 and a quarter at the moment. VIX is flat, call it, at 13.82. But the Russell is down. The RVX is down to almost 1250, down almost 1.5%. So that's a good sign for the Russell. If you continue to see, Russell vol, decrease or lower itself, that could be a really good sign for Russell pricing, especially if you can get volume to follow in there as well alongside of it. So you get lower vol, increased pricing on volume, on increased volume. That's a good triple whammy. On a week over week basis, this is kind of how I did looked at higher lows and lower lows this week. The Russell had a big higher low and a big higher high. So from a risk range standpoint, as of yesterday's closing, based on yesterday's closing price, volume volatility, that setup is certainly looking good, and that construct would actually give you a recent 1 month high and 3 month high, I believe. Let me just triple check that. But yeah. So the top end of the risk range at 2108. That puts you at a really on a 1 year basis a new 1 month and 3 month high. Just going back again, that's just going back 63 days and 21 days respectively. Obviously not all the way up to that 2108 is not to all-time highs. Those all-time highs came back in kind of that October, November time frame. I think it was November doesn't matter, around the November 8th time frame is when we put in kind of all-time highs in the Russell. So again, that was just kind of north of 2400 or 2450 and change, something like that. So just kind of keep that all in mind. That does not look the same as the NASDAQ nor S&P 500 with the NASDAQ IXIC that did recapture all-time highs most recently, and SPX continues to put in basically new highs and has captured all-time highs again in the last within the last few days. So again, just kind of be mindful of what's transpiring there. The VIX down to 13.82 is below the VIX trend line, and it has gone back to bearish trend on the page. So again, make sure you be kind of paying attention to all those things. The low end of the risk range down at 12.55, as well as the top end of the risk range at 15.32 are lower lows and high. That's an interesting setup because it's a lower low but a higher high on a week over week basis. So that risk range, that vol is widening a little bit, which just means that you could just obviously get some higher volatility. One way of tracking that is obviously the VIX. That's not necessarily what Keith puts into his system in terms of tracking the vol, but for us laymen at home, we can track the VIX, and that wider risk range on the VIX really shouldn't surprise you. Again, the fact that the VIX is up at around 86.5, and that's coming, basically has escalated from 77 and change, which is the kind of most recent 1 month low. That was put in on Thursday, February 29th. That closing low was 17.45. So again, just on that VVIX, that's that closing low on a 1 month basis, both on the look back window. It's actually the last day on the 10-day, but it's still within the 15-day. So certainly on a trade momentum standpoint, 17.45 is the low in there. And then 2 days ago on Monday, we had a little bit of ball spike and that kind of thing. The VIX put in a new 15-day kind of high there, so that was what that closed at 88.97. So we're kind of still definitely closer to that than we are to the bottom there. So just keep an eye on it. Realistically, from an SPX risk range standpoint, that's you're seeing big higher lows and big higher highs. So that risk range today is 5,071 to 5,193. And a week ago, that low end of the risk range was 5,014, and the top end was 5,150. So again, we're kind of pushing up, and Keith talked about on the macro show today, pushing up towards that 5,200 level on the SPX. That 5,200 level, I'm almost positive is currently has a lot of call resistance. So call resistance, GEX level 2, GEX level 1, GEX level 4. It's all sitting right there at the 5,200 level for SPX. So basically a lot of options, action or volume at those levels. So again, just kind of be paying attention. And interestingly enough, today's gamma wall on the 0 DTE and call resistance is 51. I think it's 5170. Sorry, 5170. Yeah, 5170 on the nose. And we've really been dancing around that level pretty much all day. I can't quite get through it. So it'll be interesting to see tomorrow whether or not, what volume comes in just across markets at the moment. I'm seeing sort of certainly pretty light volume. Basically, I track it on a 5-day average volume at time, and I'm seeing volume today on the SPX at about 40% of that 5-day average volume. Similarly, SPY's actually even worse. The SPY is at less than 30, 29 and change. QQQ at the moment is around 37% of 5-day average volume. IWM on this slight up move is also only at about 39, 40% of 5-day average volume. So again, just keep that in mind with these moves. We're kind of seeing, as you saw yesterday or coming into the open today, you had volume on really market, but kind of SPX. It was plus 18% day over day, plus 2% on a 1 month and minus 1% on a 3 month, and then plus 10% on a 1 year average. So we're kind of getting these ebbs and flows of volume days. I think it'll be interesting, obviously, with OPEX, with March monthly OPEX expiring on Friday. You've seen historically, or certainly the last few months, where you get pretty big volume days on the day ahead, so the Thursday, and a lot of the kind of the finagling or the pivots and stuff like that. A lot of folks kind of try to get slightly ahead of it, so they're not holding really 0 DTE options on Friday the 15th. So again, kind of look for some pivots and or maybe a little bit more volume tomorrow, a little bit more kind of price action. But looking beyond that, and so if we kind of go back to really where Hedgeye and Keith and the team, what we're positioning for, we're positioning for an allocation to growth, an allocation to high quality, basically high quality growth companies. So the top 50 XLG. We're looking at momentum, SPMO. We're looking at continuing to expand our exposure in emerging markets. I think one other call out there on the EM side would be India. Obviously, small caps India. If you're paying attention, those came out yesterday. So we are no longer long of the small caps in India. We remain long of INDA. However, the BSE, so the Indian rupee currency, like the home index, and not just the ETF, that did put in a lower low, although it was also a higher high. So really, some volatility is kind of creeping into the BSE. So just sort of pay attention to that. Just track that. Again, that was on a week over week basis. So it'll be interesting with this sort of down move today, what that looks like. It's very possible that just kind of becomes, you might get a little bit of a lower high there and lower high there on a day over day basis, just purely from a price standpoint. So maybe don't read too much into it on a day over day basis, but kind of just track that. I certainly am. We will have no hesitations to cut our exposure to India, even though we've been long it since June of 2023, and it's been a great run. So we'll just kind of keep an eye on that signal and what the risk ranges are telling you. Certainly, as of this morning, as I said, we actually added India both on our RTAs as well as within the Portfolio Solutions daily product. EM as well. So again, Israel, Philippines, these are really have been working out well. Saudi Arabia, KSA, the exposure to kind of to commodities, but specifically oil. Malaysia recently added. We've talked about a lot of these on here on the Notebook Review. Obviously, if you're tracking any of the Hedgeye products, you can see that as well. EMX China, I think, remains probably one of if you don't have any exposure to EMX China, I think you really need to be evaluating what you're doing. Obviously, China as well has had that pivot most recently in terms of our asset allocation towards China through FXI. That had a little bit of a hiccup, I guess, last week, so just a little bit of volatility there. But certainly rebounded. FXI has and is currently, if we close up where we are today at 24.72, as of about 12:40 on March 13th, we will get a new 1 and 3 month high. It closed there yesterday. It was a new 1 and 3 month high, so we certainly go off the closing prices. But FXI, KWeb, although we don't have exposure to KWeb, but FXI is putting in new 3 and 1 month. KWeb is just putting in new 1 month highs at the moment. So just kind of keep that in mind, or sort of keep both China as well as just EM as well. We've been long EMX China for quite a while now, for a number of months, and China certainly has crept back onto the board in terms of a not only an economic kind of quad pivot, but also the signal backing that up. In terms of other components here, obviously, if you talk about China in a sort of economic or quad, pivot in terms of their country and what's happening from a growth and inflation standpoint, you'd be pretty remiss to not call out things like Dr. Copper, even Dr. Kospi, that is also looking very good, and we have that exposure on the board too. But certainly commodities in general, copper itself, if you look at the futures, so that would be HG1 is what I'm looking at the moment. Just absolutely ripping today, up over almost 3.25%. Right up to pretty much the top of the risk range. Today's risk range, as of yesterday's close, was 4.03. So again, we're right there. The top of the risk range likely moved higher. Just FYI. Copper was added to across a couple different Hedgeye products in the last week or two, I believe it was. And again, so copper again, just kind of confirming or certainly has been a good asset allocation to have in the books over the last 2 weeks. But at the same time, at the top of the risk range, you would be taking some profit, and you'd be reducing a little bit of that position. But copper, commodities as a whole, if you're looking at agriculture, whether through an ETF like DBA, so that would be a commodity like an ag commodity basket. We called that one out, I believe, last week, maybe even the week before. But basically, that's also, as of yesterday's close, it put in a new 1 and 3 month high as well in terms of DBA. DBB, obviously, with its base metals move in terms of copper. Really, DBB, interestingly enough, only has 3 exposures. I think it's copper, zinc, and maybe aluminum. I'll double check for everybody what that third one is, but obviously this movement copper is really helping DBB put in a new 1 month high. But in terms of signal strength, ag DBA certainly looks more robust. So keep that in mind. DBA, commodities in general, and again, whether you're expressing like commodities or oil, through USO or something like, or you're playing the futures, CL, that is certainly regaining its signal strength as well. I've been trading kind of sideways the last month, though, so I'll just keep an eye on that one. However, on a week-over-week basis, we did get a higher low, although we also got a lower high in both crude and Brent. But that lower high at 79.95 is basically sitting right at 1 and 3 month highs. So just kind of keep an eye on that one. You could, again, you'd want to see from a signal standpoint and to perhaps increase your asset allocation towards crude oil or just oil in general, you'd want to see that top in the risk range really indicating a new 1 and 3 month high, and the low end of the risk range basically indicating a higher low. So at the moment, you're getting higher lows in the risk range, but you're also getting some lower highs. That is also a direct correlation in regards to OVX. Oil vol is down about 185 basis points over the last month, 83 basis points in the last week. So that's down almost about 6% in the last month in terms of oil vol OVX, which yesterday closed at 29.36, and we are currently sitting right there, 29 and a quarter at the moment. So with oil vol down these levels, you really just kind of, again, it's really, it's a beautiful thing in terms of looking at both price action, volatility, and then when you can also add on volume, you really get quite a triple whammy. And I saw a tweet this morning, I think Keith retweeted it, but a gentleman mentioned how just getting your eyes opened to price volume volatility and really just gives you quite an edge. And I would absolutely echo that. That was one thing that stumbling upon Hedgeye, I certainly, that was a huge eye opener for me as well. So price volume volatility are 3 components that I constantly monitor, constantly watch, and really helps me make better decisions. So that's oil. Gold, man, gold has just been an absolute ripper. It has been a ripper. That 1 month low is about to fall out of the kind of look back window on a 21-day basis. That happened on February 14th, down at 2004 spot 30, if you can believe it. We're now trading well north of 2100 at 2177 on the nose as of right now. So again, just been a great move. Gold volatility certainly expanded on that move higher, and it went from basically just around 11 all the way up to 15 and change. We're now kind of back at 14, just under 14 on GVZ. So gold vol has come back, has come down as gold has sort of really kind of had a slight pullback over the last 2 days. But so again, with this gold volatility down, you may end up seeing a little bit of consolidation here within the price action as we move out in time and space. But we'll see what happens. I mean, gold vol spiking higher has basically for the last year, maybe 18 months. It could be even longer than that, but I'm just going off memory in terms of things that I've seen. And gold volatility spikes have really correlated with big moves in gold price as well. So certainly in the case of gold, spikes in volatility has certainly been it's been good for gold price. And I see my good friend Mr. Moyer is out there. He often has reminded us that, or has made a point on Notebook Review, that that kind of correlation is likely because of the way that big funds and people that have gold exposure and play in the space, how they express that exposure. And I believe it's primarily because it's through gold future options and options trading. All right, so through commodities, other commodities to be looking at. I talked about copper. Uranium obviously has been has sort of been along on our board up until about 2 weeks ago, I guess it was. And that uranium URA, so that's the ETF, not necessarily the futures contract, but that is neutral on the page in terms of a trend signal. So typically that just means it is, the price level is between both trade and trend levels. And but you are, on a week-over-week basis on URA, you are seeing a higher low and a higher high. So could we see some volatility come out of URA and see some price, maybe even just some consolidation? That would be certainly bullish for its signal strength, generally speaking. But at the moment where you have the top end of the risk range at 29.18, and the low end of the risk range at 26.92. You're seeing a top end of the risk range that's really right in line with the most recent high that happened on March 7th, last Thursday, and that's not a great thing. Sorry, that Actually, you're inside of that recent high. Excuse me, apologies. That high was 29.35. And I said that was 29.18, right? So 29.18. So we're kind of sitting right in between, right underneath the 1 month high. So again, and that's a new 1 month high. So it's going to be, you're going to want to see that top in the risk range overtake that pricing, that 29, what I say was 29.35, I believe. 29.35. So you're going to want to see that top in the risk range, kind of creep up over that in order to sort of get me more interested in uranium. For the time being, it's, as it says on the page, it's neutral, which really means I don't really want to be touching it, right? I don't want to be playing it. I got a lot of other places that are signaling that have much better signal strength. As I just mentioned, DBA is one of those. DBB is getting there, and certainly copper in and of itself would be there as well. UGA, I believe we talked about last week or the week before. That's gasoline. It's in the Portfolio Solutions product. So we do have exposure to gasoline, to United States gasoline. That's having a great move today. So again, not just calling it out because it's up, but it's up about 2.5%. And again, if we close up here, it would be a new 1 and 3 month high. So last week and the week before, we were kind of talking about it in terms of, could it be breaking down? And that we want to see it basically put in new highs, and it's doing that. So although this is like one of these ones where it gets a little tricky, where you're like, oh well, fuck, I just missed that 2.5% move higher today. But this is exactly what you kind of want to see. After a consolidation period, you either almost, again, it kind of goes against sort of some of the Keith's, to stay in line with sort of Keith's mantra and Hedgeye mantra. You'd want to be there on sort of the next red day. So that might happen tomorrow, might happen next week. We'll have to see. But you could also, if you don't have any position at all, you probably want to have think about on any kind of little pullback today, maybe adding a minimum size position or something like that. Now that you've got confirmation in price, so again, this is a good thing and not one to be kind of upset that you missed it. But at the same time, there's a lot of places that you can go in terms of finding assets or pieces of inventory to put into your own portfolio. The treasuries and basically fixed income, that's been an interesting one. And again, it's reading neutral on the page. So I'm just going to go back to the fact that neutral means just give it time and space, and just kind of reiterate the same comment I made for uranium. But at the same time, the 30-year, 10-year, 2-year, all making lower lows and lower highs. The 2-year does remain, U.S. Treasury 2-year, does, just to be specific, is still signaling a bullish trend with the risk range of 4.46 to 4.70. The trend level there on the 2-year, so be paying attention to that one, is 4.51. So what you're seeing there with the risk range is that it is possible that we do break trend to the downside, and then that would obviously move that to kind of a neutral or bearish trend on the U.S. Treasury 2-year. So again, just keep an eye on that. Anytime that you've got the risk range kind of hovering around key levels like trend and trade, you want to be paying attention to those because you could see kind of movements and or pivots there from a phase transition or otherwise speaking in that piece of inventory. Interestingly enough, the low end of the risk range on the 10-year is just north of the tail level, which I believe he said this morning was 4.02. So that's the U.S. Treasury 10-year. It bounced basically right off of it. I believe it was yesterday or the day before. So it held that tail level. So keep an eye on that one. Obviously, if that basically starts to go, then that could be sort of some green lights and likely something where you'd see that trend change from neutral to bearish. And but for now, it's really just a wait and watch situation in regards to the longer end of the curve, and a very much a sort of business as usual for the time frame on the shorter end of the curve, which is up slightly today at 4.616 at the moment. 10-year is actually up at 4.19. So 10-year, 2-year. And the main takeaway here for me on that is the move index. Move it down at 101, and that is fresh kind of 1 month, and we're pretty close to 1 month lows. And the more traditional regime for the move is down at 60. So if we can really break down here, who knows? We may get back to that regime level. That was really the main takeaway there that I was talking about for the last 5 minutes that I did in 30 seconds. And I'd rather stop talking, Mr. Moyer. So do you got anything on your end? Let me get a little water. Can't believe I keep fucking up spaces. You know, you think for a guy who's been doing this for like basically 2.5 years that I'd have this shit figured out. Hey, Moyer?
I don't know if Hedgeye want to pay for you to have a separate phone. Normally, no, I'm being serious. Like, because normally it's things like phone calls and stuff cut them off, don't they?
Yeah. But this time I think I just fat fingered. I hit mic mute when I picked up my phone a minute ago. To be honest, this is just user error.
Well, that's situation's fault, man.
Out there. This is just me being a donkey, basically. So yeah.
I tried to give you an out.
I know you did. But you know, it's all about accountability. I got to be accountable for my idiocy. So yeah. I know you track currencies a lot. I haven't really touched base on currencies yet. A big call out, obviously. The one that kind of looks the best to me would be euro, and then the yen versus the dollar. I don't know if what you're seeing. Obviously, big higher highs as well within the pound versus the dollar. But just you seeing any interesting crosses on your end?
I'm going to be very boring and say no because I haven't really been watching it because I've been doing other stuff.
Yep, totally cool.
So I kind of go through these periods of when I'm making something, I try not to trade because I end up screwing both the making and the trading up. So I just put one aside and focus on the other until that's finished, and then I look back again.
No, I love it. Yeah, no, it makes perfect sense. And I'll just go, so X2, I think it was like 2 weeks ago, he asked about the euro, and my response was like he'd really go either way, and the way it went was up. So that continues to put in basically, if we close up here, I think we're going to recapture 1 month highs. 109.48. Basically, I think we'll recapture a new kind of 1 month high. So the euro, the top end of the risk range is 109, 1.099. So that would, again, that's a really good setup, although we're not, that's not indicating higher 3 month highs. That would be up towards 1.11. But you got to get there somehow. And in order to do that, you kind of recapture near term trade momentum, which would be on a 15-day and 21-day basis. So yeah, that's one reason why the euro to me looks really good. The yen on the other side, if you look at that again, Chris, I know you're not looking at those, but USD JPY, and you're probably rolling your eyes right now because I'm only focusing on US dollar crosses, not really cool shit like the Aussie versus yen and all this other stuff. But the low end of the risk range there today is 145.88 in terms of USD JPY. And again, that's basically would be putting in kind of or signifying new 1 month lows, and that's really rolled over. The yen has versus the dollar in the last week plus. Yes,
the intervention zone.
That's right. So it'll be interesting. So again, like that 3 month low, Chris, as you probably remember, is down towards kind of like 142 basically. So it'll be interesting to see if we get back to those levels. But the other interesting part is that we're 15th, that low was on the 29th. So come basically the end of the month, so give it another couple of weeks, those lows are going to fall out of the look back on a 63-day basis, and then it gets a little easier to basically eventually, as you go out in time and space, potentially regain or put in new 3 month lows in addition to 1 month lows for the Japanese US dollar JPY cross. All right, a lot of friendly faces out there. Let's open it up. Obviously, Chris, if you got anything else that I'll kind of pass the baton to you if you wish it. But we can talk about any signals, any questions, anything like that. Gotta keep this one a little bit tighter today because I got a call here at 1:30. But let's open the floor. This obviously for those that may or may not be familiar with the notebook review, this is where we we review kind of things that are popping off the page, whether it be, again, a page is a loose term. It can be on your trading screens, whether for me, I use TradingView, but whatever tool that you use in terms of like signals, trends, portfolio positionings, construction, kind of how folks are within Hedgeye Nation are thinking about that or that kind of stuff. And as I let people kind of jump up and again, I'll turn it over to you, but just to finish off kind of a couple things that were starred in my notebook this morning. It was high yield growth, LQD, so investment grade credit on the fixed income side, the BSE, so that's the India Stock Exchange. That was also starred, as I've talked about already, copper as well, and then the USD JPY cross. The other one too that I did want to highlight, although it is bullish trend, pink is putting in a higher low and a lower high. So that lower high, especially after a big run that it's had, and Keith actually was a seller this morning within RTAs and as well as within Portfolio Solutions. So could that be signifying kind of a little bit of a weaker signal or not quite as robust? Obviously, healthcare has had a massive run since November, both whether you're looking at pink or XLV. So just wanted to kind of call that out. Doesn't mean that you do anything there in particular today, other than maybe reduce some sizing and give it some time and space, because otherwise it is bullish trend, and things look generally good. But just wanted to call that out. It could, again, just could be some volatility kind of coming out of that with a little bit of consolidation here over the course of the last 10 to 15 days.
I think there's quite a lot of active ETFs coming out, and it'll be interesting. I mean, obviously, like the quads is done on a back tested basis, but I mean, I guess not the quads. The key signal, yeah, that's fine. But in terms of like a quad thing, if you've got an active traded ETF, I'm not sure whether the quads quite fit because you don't know necessarily how the portfolio manager has moved stuff around. That's super interesting because I know there's quite a lot of more, a lot of people are transferring from mutual funds or starting completely separate and just doing an active portfolio, but within an ETF, right?
Yeah. You've seen that. Obviously, that's been relatively, less, call it 18 months, 2 years. You've kind of seen that theme transpire, whether it be through Simplify or Crane Shares or really anywhere, even State Street, BlackRock, whatever, et cetera, et cetera. So, yeah, man, I think it is definitely interesting because it really, depending on what the active ETF is really focused on, some are focused more on income. There's like the cows, I think it is, or cow is, I think cows with a Z, right? Yeah, that's like US cash cows, top 100 of those. That thing's been ripping as well. Putting in, if it closes up here, we'll put in a new one in 3-month high as well. And obviously puts out a good dividend. But yeah, these things from a back test standpoint, and depending what's inside of their portfolios, really will determine kind of how well they do in certain regimes, whether it's growth slowing, growth accelerating, inflation accelerating, staying flat. Obviously, with the print yesterday, Keith talked about on the call as well as macro show today. But we've got inflation staying staying stickier, higher for longer, and really the I kind of in prior notebook reviews and in other places kind of talked about how inflation for us was kind of was somewhere between 3 and 3.25. It's basically staying around there, but it's crept higher in terms of we're not really getting down towards 3% anymore, Chris. We're more like it's a pretty tight band actually between 320 and 332 over the course of the next including Q1 out to Q4 of 24. So kind of will be interesting. And really what that's implying as well is basically we're seeing quarter over quarter positive rates of change in inflation. Again, modest in terms of from a delta standpoint, but they are there. So will be interesting to see kind of how, to your point, bringing it back to your comment, how these active ETFs, how they fare in kind of inflationary environments that are sort of stickier for higher, and with relatively small delta changes.
Yeah, it seems like on the, so I've turned into an internal spy monkey. So I've been looking at all of the individual, so looking at the stocks individually, which has been something new for me.
Yeah.
But I mean, like, so at least by the way I track it, I know you guys, like Jay and stuff, have been talking a lot of industrials, but the way that I track it, all of the energy names are starting to look, like the industrials did maybe 2-3 months ago, which is interesting. So I'm kind of sitting on my hands because I wish I already owned them, but the signal hasn't told me to buy them yet.
Yeah.
But yeah, it's so yeah, this inflation part, at least for me, how I like trading commodities and stuff, so that's definitely on, it's where I like to play anyway.
Yeah, I mean, I was seeing that today when I was looking at kind of just the sectors themselves, Chris. It was like XLE is up 1.5%. It's number one. Yeah, it's number one on the board at the moment. And funny enough, tech is the leading the pack to the downside, down almost 1% in terms of XLK. And then materials is right there behind energy, and XLB has been quite an outperformer as of late, alongside industrials. Just if you go back to either a 1 month or sort of 3 month basis, certainly on a 3 month basis, XLB and XLI are kind of are right there. So and then again, in terms of like the industries, like GDX is actually the leader of that pack, and XOP is right behind it in terms of oil and gas, E&P. So that's obviously, again, like an interesting component there. GDX has certainly picked up signal strength, and I was looking at it today, Chris, and it was in terms of the energy guys, GDX, although just sort of starting to really get some wind here in the last 10 days. But man, it's been a heck of a move from basically 26.5 to 30.5. So there's a lot of upside, I think, from there. But from a signal standpoint, just sort of starting to gain some signal strength, which is a good thing. But that certainly happens when you've got the gold move that you have seen in the last 10 days as well, 10 to 15 days, call it, or last month on the gold side. And then when you got the rest of these commodities from a GDX and or XOP standpoint, yeah, I mean it's going to be interesting because whether, even though these deltas, as I just alluded to, even though the deltas in terms of the rate of change, positive growth inside of our expected or estimated inflation numbers, even though they may be small, it may just be one of these things where sticking around 3.25 to 3.30 is enough for just commodities, generally speaking, and certainly anything energy. GDX, miners, XOP, oil and gas, OIH, anything of that realm. Could it be another, kind of bull cycle for those guys like we saw? What was that back in, I guess 22, right? We saw energy had a pretty great run, I think it was, and obviously back in 21 as well, or 2020.
Yeah, I mean, like, a shout out to I think Tim
Bozeman, he was. Tim, he's down there. Yeah, he's down there.
I was speaking to him last week, and he, in terms of like the services, in terms of like OIH, he kind of made the point that, well, if oil does well, all of the producers are going to delay their maintenance periods, so the services may not do as well, because they'll push back any of their maintenance periods and stuff to try and capture the price. So that's super interesting. And that's, whereas in the past I liked looking, why is oil doing this and copper is doing that? And now I've gone to the dark side and looking at stocks. It's super interesting where you could go inside of that and say, okay, well, why is this one, doing something different to this one, even though in inverted commas, they're all energy stocks. So that's been super interesting to look at.
Yeah, it's I think a good example too. Again, just like to bring it back to sort of more metals and mining oriented. But I mean, you can see it inside oil 100%, right? But like XME looks like a lot different than GDX, which again, is mainly because of like what's inside of it in terms of the larger components. But it is certainly interesting. And then same thing with OIH versus something like an XOP. XOP is putting in new 1 month and 3 month highs. OIH is sort of they just don't, signals just aren't quite the same on those things in terms of oil services, and that's an interesting component. I always love his insight because he has boots on the ground out west, at least in the U.S. here. So always good to see what he's thinking. And energy and XLE, obviously that's a lot of the big boys in terms of Chevron and ExxonMobil and stuff like that. So, and then even Devon Energy, natty gas, looks like absolute garbage. Continues, which is funny. I haven't dabbled in natty gas in a while because it's just the signal's just been so bad. But if it can somehow muster some form of maybe even just move back up to $2, it'll be interesting to see what that does for some of the natural gas companies. I think it's FCG is that natural gas ETF that has a lot of the energy or kind of the energy producers in there, but that also incorporates some oil names too. So FCG. So what that's Frank, Charlie. What's G again? Gamma? No, that's not Gamma. What's G again? What's G again, Chris?
FW.
Is it Gamma? Oh, yeah. Pat on the back for Robbie. Frank Charlie Gamma. I think I got that right, didn't I? Yeah, good for me. But FCG looks a heck of a lot different than UNG, which again, it's interesting.
It's super fun. I think the last time I can't remember the last time I joined one of these live, but it was probably the last time that the UK was going to, sink into the Atlantic Ocean because natural gas prices were going so high, right? And now look at where they are now. It's insane.
Yep. It is insane. Yeah. Yeah. I mean, again, like, Keith talked about it on the macro show today and Steiner talked about it on the call this morning, but in terms of, again, like not obviously natty gas, but just rate cuts and just the expectations coming into the year, in December versus where we are today. We're down to like 3 expected rate cuts here in the U.S., which is, completely different than I think it was 6 or 7 as we entered the year. So just in a matter of, basically 2.5 months. And it's amazing how that's changed as well, which is just, just like an interesting component.
But that's super, like, less so on that point on its own, but that's why for me, I don't really listen to all the news and everything. It's because like you end up chasing your tail.
Oh yeah.
I mean, could you imagine, 3 months ago, let's say 3 months ago or 6 months ago, could you imagine saying, well, Apple's down 10% and the S&P 500's up 10%?
Yeah, it's hitting all-time highs.
Because the whole, exactly. Because, for the last, forever. But, for whatever period beforehand, it was the S&P did whatever Apple did.
Mm-hmm.
And now that isn't the case. But there's all these things that are attached to, they're attached to our priors and, oh, this happens because of this. And then, and then it turns out, oh no, it doesn't do that actually. It's,
Yeah.
That's why I've turned it all off, because you just end up chasing your tail, and it doesn't help. It just hinders.
Yep. No, I'm with you in terms of, focusing more on signal and trying to stick with bullish trends and things that have good signal strength. I mean, that's been we talked about it with Philip last week on here. So if anyone listening in, if you want to kind of go review some of that commentary, by all means go do so. But yeah, it's a crucially important pivot that I've certainly made alongside of you, Chris, and it's been transformative in terms of the old PA and the portfolio construction. And I always had no problems kind of filtering out the noise, but really just kind of letting that impact general, or kind of like, just letting the signal kind of dictate where the pivots where they need to go and what they need to be. That certainly has been really helpful. All right, well, no one else is kind of stepping up here, Chris. So yeah, we'll just kind of wrap up. I think that's a good point to kind of finish with, is just to stick with the signal right now. Things certainly not a whole lot has changed on the page. SPX, as I mentioned earlier, remains bullish trend. So is the Nasdaq and the Russell, and the Russell is certainly acting a little bit differently today, where it is positive, and that Russell vol is down at 20.5 and down almost 2% now. So keep an eye on that. Vixen is a little elevated here. Kind of can't quite break down below 18. So keep an eye on that one from a Nasdaq volatility standpoint. I really kind of want to see that kind of break down below 18. Again, I'm kind of rounding off Keith's trend level there. But so kind of keep an eye on that bad boy. And then VIX is really kind of sitting right around the trend flip line from the last one I have, I think, was from last week for VIX. Let me just double check that. Yeah, 3.5. And I had it down at 385. So we're sitting right there. So that level's probably changed a little bit, maybe correct a little higher. So just want to kind of call that out too, though. But it's certainly, and I suspect it has crept higher because we are bearish trend on the VIX. But we're kind of like right around some key levels, right in the middle of the risk range. So we could see it go with volatility going into the OPEX. We could see it kind of go back at the top of the risk range, but then quickly move lower again thereafter, like we saw coming into the CPI print yesterday. So keep your heads on swivel out there, guys. Thanks for tuning in. We appreciate it. Chris, always a pleasure. It's great to have you on live here. Glad to do it. And this is as good a week as any, since we are 1 hour closer to you, given that it is, we went daylight savings, and you don't do that for another week or so. So always makes it a little easier. We're only 4 hours apart, but always good to have you on, man. Love your takes, and thank you very much for tuning in, because I know it is getting close to dinner time and on the other side of the pond.
Yeah, cheers, buddy. Have a good one.
Yep. All right, guys. Have a good one. We'll see you all next week, and I'll be on the Macro Show Friday with David Salem, so tune into that as well at 9 a.m. Cheers.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.